Let me ask you a question. If Congress changed the tax laws tomorrow, would your retirement plan still work the way you expect? Most people believe the biggest risk to retirement is the stock market. Others believe inflation is the biggest threat. Every year, the cost of groceries, healthcare, housing, and everyday necessities continues to rise. And many people worry that their retirement savings won't keep up. Some people worry they'll simply run out of money. After decades of working hard, the last thing anyone wants is to spend retirement wondering whether they'll have enough to enjoy the life they've worked so hard to build. But after helping thousands of families across the country think through retirement planning, I've noticed something that almost nobody talks about. It's not just about how much money you save. It's about how much of that money you actually get to keep. Taxes. For many retirees, taxes become one of the biggest expenses they'll face. Not because they did anything wrong, but because no one showed them how different retirement strategies can affect the income they actually keep. Many hardworking Americans did everything they were told to do. They worked hard. They saved consistently. They invested for retirement. Yet very few were ever taught about tax diversification and how it can play a role in retirement planning. That's why I created this presentation. Not to convince you to buy something today, but to help you understand retirement planning options that many people never hear about until it's almost too late. Whether you already work with a financial professional or you're just starting to think seriously about retirement, my goal is to give you information that helps you make more informed decisions. Because retirement isn't just about building wealth, it's about protecting it. It's about creating flexibility. And it's about making sure the money you've worked your entire life to save is working as efficiently as possible for you and your family. Let's get started. When most of us started working, we were given a simple retirement formula. Work hard, save consistently, contribute to your retirement account, and someday, everything will work out. For millions of Americans, that has been the standard advice for decades. And to be clear, saving for retirement is a good habit. Building financial discipline and investing for the future are important steps toward long-term financial security. But here's a question that isn't asked often enough. Has the retirement landscape changed? People are living longer than ever before. Healthcare costs continue to rise. Inflation affects the purchasing power of every dollar we save, and tax laws can change over time. All of these factors can influence how far retirement income may go. That's why retirement planning today isn't just about accumulating assets. It's also about creating flexibility, having multiple sources of retirement income, understanding how different accounts are taxed, and building a strategy that's designed to adapt as life changes. The goal isn't simply to retire. The goal is to retire with confidence. To know that you've prepared not only for the expected, but also for the unexpected. Because when retirement planning focuses only on one strategy, you may miss opportunities that could strengthen your overall financial plan. In the next chapter, I'll share the personal experience that changed the way I think about retirement planning and why it inspired me to help families explore a broader range of options. There are moments in life that change you forever. Sometimes they happen in an instant. Sometimes they happen so slowly. You don't even realize you're changing until one day you look back and see the world completely differently. That was my journey. When I first entered the financial industry, I thought retirement planning was simple. Work hard, save your money, invest consistently, retire someday. Isn't that what most of us were taught? But then something happened. I started sitting across the table from real families. Not statistics, not spreadsheets, real people. People who had spent 30, sometimes 40 years working for everything they had. Some had pensions. Some had built impressive 401ks. Others had saved diligently through IRAs. Some owned businesses. Others worked with their hands every single day. Teachers, nurses, truck drivers, police officers, firefighters, factory workers, small business owners, different careers, different incomes, different backgrounds. But after every meeting, I noticed something that stopped me in my tracks. No matter how successful they appeared, they all carried the same quiet fear. What if it isn't enough? That question stayed with me, because behind those 5 words wasn't just money. It was a lifetime. A father who missed birthdays because he was working overtime. A mother who put her children's dreams ahead of her own. A couple who postponed vacations year after year because retirement came first. Every retirement account represented decades of discipline, years of sacrifice, thousands of early mornings, late nights, missed opportunities, dreams placed on hold with the hope that someday it would all be worth it. And then came the questions. What happens if taxes go up? What if inflation keeps rising? What if I outlive my savings? What happens to my spouse if I'm no longer here? Those weren't investment questions. They were life questions. And in that moment, I realized something that changed the course of my career. People didn't just need another financial product. They needed someone who would slow down, listen, educate, and help them understand the choices available before making one of the biggest financial decisions of their lives. That realization became my mission. Not to tell people what to do, not to sell fear, but to replace uncertainty with understanding. Because when families understand their options, they make better decisions, they sleep better, and they move toward retirement with greater confidence. Everything that follows in this masterclass is built on that mission. My goal isn't to tell you what to think. My goal is to give you the knowledge to make the decision that's right for you and your family. Let me ask you a question. Do you remember the story of the 3 little pigs? It's a story almost all of us heard as children. The first little pig built his house out of straw. It was fast. It was easy. It required very little effort. The second little pig built his house out of sticks. It looked a little stronger, but it still wasn't built to withstand life's biggest storms. Then there was the third little pig. He chose a different path. He invested more time. He worked harder. He planned ahead. He built his house one brick at a time. And when the storm came, his house was still standing. Now let me ask you another question. What if that story wasn't really about houses? What if it was about retirement? Because whether we realize it or not, every single one of us is building our retirement house right now. Every paycheck, every financial decision, every dollar we save, every choice we make adds another brick or leaves another gap in the foundation. And just like in that story, life eventually brings storms. Markets rise and fall. Inflation quietly reduces purchasing power. Healthcare expenses can increase. Tax laws may change. Unexpected events happen. None of us can stop the storms, but we can decide how prepared we'll be when they arrive. Over the years, I've had the privilege of meeting people whose retirement looked very different from one another. I've met people living what many would call an ideal retirement. Their mortgage was paid off. They had multiple sources of retirement income. They traveled when they wanted. They spent time with their children and grandchildren. When an unexpected expense came along, they handled it with confidence instead of fear. Money no longer dictated every decision. Freedom did. I've also met people living a very different retirement. They had enough to get by, but every month required careful planning. Every grocery bill mattered. Every medical expense created stress. Every vacation became another conversation about whether they could really afford it. They weren't living the retirement they had imagined. They were simply trying to make it through each month. And then I've met people whose retirement never truly began. Not because they were lazy. Not because they failed. Many had worked 30 or 40 years. Some had pensions. Some had spent decades building their 401ks. Others had saved faithfully in IRAs. They did what they believed was right. But life doesn't always follow our plans. A health crisis, a layoff, a divorce, helping aging parents, supporting children or grandchildren, economic downturns, unexpected events that changed everything. Today, many of them continue working. Not because they still love going to work every morning, but because financially, they simply can't afford to stop. 3 different retirement stories, 3 different outcomes. And here's what changed my perspective forever. The difference wasn't always how much money they earned. It wasn't always who had the biggest paycheck. Very often, the difference was the strength of the plan they built over time, the questions they asked, the advice they received, the options they understood, and the decisions they made along the way. That's why I believe retirement planning isn't about chasing the perfect investment. It's about building a stronger foundation, brick by brick, one informed decision at a time. Because retirement isn't just about reaching age 65 or 67 or now, some government officials say 70. It's about waking up one day with confidence instead of uncertainty, with freedom instead of fear, with choices instead of limitations. In the next chapter, I'll introduce one of the retirement planning strategies that many Americans have heard about, but few truly understand, and explain why, for some families, it can become one important brick in building a stronger retirement foundation. Because every strong house begins with the right foundation, and every confident retirement begins with a thoughtful plan. For decades, Americans have been given a familiar retirement playbook. Go to work, contribute to a 401k, open an IRA, invest for the long term, and hope that one day there will be enough money to retire. These strategies can be valuable. They have helped millions of people accumulate money for the future. But before we decide whether they are enough, we need to understand exactly how they work. Because a financial tool should never be judged only by what it can do. It should also be judged by what it cannot do. A 401k is a retirement account offered through an employer. You contribute part of your paycheck. Your employer may match part of that contribution. And that employer match can be one of the most valuable benefits available to you. With a traditional 401k, contributions may reduce your taxable income today. The money grows tax deferred. But tax deferred does not mean tax free. It means the taxes have been postponed. After 20 or 30 years of saving, you may open your statement and see a significant balance. Maybe $500,000, maybe $750,000, maybe even $1 million. But the number on the statement may not be the amount you can actually spend. When money is withdrawn from a traditional 401k, the taxable portion is generally included in your income. You received a tax benefit when the money went in. The government may collect its taxes when the money comes out. And no one can guarantee what tax rates will be 20 or 30 years from now. What happens when you need money before retirement? Some 401k plans permit loans, others do not. When loans are available, the amount is generally restricted. Repayment rules apply, and the loan may become more complicated if you leave your employer. So even though it is your retirement account, access may depend on your employer's plan, federal limits, and a repayment schedule. A 401k is designed primarily to accumulate retirement assets. You can name beneficiaries to receive the remaining account balance. But a 401k is not life insurance. It does not automatically create a larger death benefit if you die before completing your savings plan. Suppose your goal is to accumulate $1 million, but you die after saving only $100,000. Your beneficiaries may receive the remaining account value, but the 401k does not automatically complete the $900,000 you never had time to save. The account also does not inherently provide benefits for a qualifying critical, chronic, or terminal illness. Those protections would have to come from somewhere else. Now let us look at the IRA. An IRA is an individual retirement account. Unlike a 401k, it is generally opened independently rather than through an employer. An IRA may provide more investment choices and more personal control. But just like a 401k, an IRA is an account, not an investment by itself. You may place stocks, bonds, mutual funds, or index funds inside it. If those investments rise, your account may grow. If those investments fall, your account may lose money. There is no automatic insurance floor protecting stock investments inside an IRA or 401k from a market decline. A traditional IRA may provide a tax deduction depending on your individual circumstances. Its earnings can grow tax deferred, but taxable distributions are generally included in income when the money is withdrawn. Again, tax deferred does not mean tax free. It means the tax may be waiting for you in retirement, and the number on the statement may not be the amount available after taxes. A Roth IRA works differently. Contributions are generally made with money that has already been taxed. The account can grow tax-free, and qualified distributions may be income tax-free. That can make a Roth IRA an excellent retirement strategy. But Roth IRAs have limitations. Annual contribution limits restrict how much money can be deposited. Income restrictions may reduce or eliminate a person's ability to contribute directly. And the Roth tax treatment does not protect the investments from market losses. If a Roth IRA is invested in stock funds and the market declines, the account value can decline. A Roth IRA can protect qualified withdrawals from income taxes. It does not protect the account from market risk. Can you borrow from an IRA? No. Participant loans are not permitted from traditional or Roth IRAs. You can take a distribution, but a distribution is not a loan. Depending on the account type, your age, and the reason for the withdrawal, taxes or additional penalties may apply. So the traditional retirement tools have important strengths, but they also have limitations. They can help you accumulate money, but they may expose that money to market losses. They have government-controlled contribution and access rules. Traditional accounts may create taxable retirement income, and by themselves, they do not provide life insurance or living benefits. Something is missing. Now imagine watching a movie where the hero prepares for every possible challenge. He has the plan, he has the tools, he has the training, but he forgets one thing: protection. That one missing element changes the entire story, because growth without protection can leave a family exposed. A retirement account may help you accumulate money, but what protects the plan if you die too soon? What protects your family if your income suddenly disappears? What happens if a serious illness interrupts your ability to work? What happens if the market falls just before retirement? And what happens if taxes are higher when you need the money? Those are not investment questions. They are protection questions. And protection is something we already understand. We insure our homes. Why? Because a fire, hurricane, or accident could destroy in minutes what took decades to build. We insure our cars. Because one collision could create a major financial loss. We carry health insurance. Because one serious illness or medical emergency could cost more than many families could afford. We purchase disability insurance to help replace income when a qualifying disability prevents us from working. And we purchase life insurance because the people we love may still need financial support after we are gone. Insurance exists to transfer risk. It helps protect us from losses we may not be able to handle alone. But what if insurance could do more than provide protection after a tragedy? What if one type of insurance could help protect a family, build cash value, provide access to money, create potential retirement income, and leave a legacy? That is where the story changes. Imagine walking into a room. On the table are several separate financial tools. One tool is designed for life insurance protection. Another is designed for cash accumulation. Another may provide living benefits during certain serious illnesses. Another may provide access to money through loans. Another may help create tax diversification in retirement. Traditionally, you might believe you need a separate product for every objective. But what if several of those features could be placed inside one specially designed financial package? That package is called Indexed Universal Life Insurance, or simply IUL. An IUL is not a 401k. It is not an IRA. It is not a mutual fund. It is not direct stock market investing. It is permanent life insurance with the potential to accumulate cash value. But what makes it special is the combination of benefits it may provide when it is properly designed, properly funded, and properly managed. Benefit 1. The first purpose of an IUL is life insurance. If you die while the policy remains in force, your beneficiaries may receive a contractual death benefit. That money may help replace your income, pay off the mortgage, pay final expenses, eliminate debts, support your children, fund education, protect a business, or create a legacy. Remember the person whose retirement goal was $1 million but who died after accumulating only $100,000. A retirement account generally transfers only the amount that remains. A life insurance policy may provide a contractual death benefit that is significantly larger than the cash value accumulated at that time. The death benefit does not simply protect your money. It helps protect the future you intended to build for your family. The second benefit is an IUL may also accumulate cash value over time. Part of the premium supports the life insurance benefit and policy expenses. The remaining value may accumulate within the policy according to its contractual terms. The policy may offer several interest crediting options. One of those options may be linked to an index such as the S&P 500. But before we explain how that works, we need to understand the index itself. What is the S&P 500? The S&P 500 is a stock market index that measures the performance of approximately 500 leading American companies. These companies represent many parts of the economy: technology, healthcare, banking, energy, manufacturing, communications, transportation, consumer products, and many other industries. Think of the S&P 500 as a giant scoreboard. It measures whether the overall value of those major companies is moving up or down. But the index itself is not something you can purchase directly. It is only a measurement. What is an index fund? An index fund is an investment designed to follow the performance of a market index. An S&P 500 index fund generally purchases shares of the companies represented in the S&P 500. When those companies increase in value, the fund may grow. When those companies lose value, the fund may decline. A person invested in an S&P 500 index fund may receive strong market growth and applicable dividends. But that person is also directly exposed to market losses. An IUL works differently. The policy owner is not directly investing policy cash value in the S&P 500. The insurance company uses the movement of the index as part of a formula to calculate potential interest credits. That difference creates the next benefit. The third benefit is index-linked growth potential. Suppose the S&P 500 rises during a policy's index period. The IUL may receive an interest credit based on that positive movement. But the amount credited may be limited by a cap, a participation rate, a spread, or another contractual formula. For example, imagine an IUL has a 15% cap. If the index rises 10%, the account may be credited up to 10%, depending on the policy's participation rate and other terms. If the index rises 25%, the credit would be limited to the 15% cap. That means the policy does not receive all the market's upside, and that is an important trade-off. You give up some of the market's highest potential gains in exchange for another powerful feature: protection from negative index credits. Benefit 4: protection from losses. The 0% floor. Now imagine the S&P 500 falls 20%. A person directly invested in an S&P 500 index fund could experience that loss. But an IUL index strategy with a 0% floor would generally receive a 0% index credit instead of a negative 20% credit. Let me put that in simple language. If the index has a negative year, the index account does not receive a negative index credit. The floor helps protect the policy's index value from market index losses. That does not mean the entire policy can never decline. Insurance costs and policy charges still apply. Withdrawals and loans can reduce policy value. A 0% credit does not mean zero policy expenses. But the market itself does not create a negative index credit during that period. The correct message is not, you can never lose money. The correct message is, the 0% floor protects your indexed account from losses caused directly by negative index performance. That is the protection feature. So which is better, bigger gains or fewer losses? Now we come to an important question. Over the long term, what is better? Receiving higher gains or avoiding major losses? The honest answer is that it depends on the person, the timeline, and the objective. Historically, directly investing in a low-cost S&P 500 index fund has offered greater long-term growth potential. Why? Because direct investors can receive uncapped market gains and dividends. An IUL does not directly receive index dividends. Its gains may be limited by caps, participation rates, or other policy rules. So an IUL should not be sold as a guaranteed way to beat the stock market. That is not its purpose. The IUL offers a different exchange. It trades part of the market's upside for protection from negative index credits and combines that protection with insurance benefits. For someone who wants maximum market growth and can tolerate major losses, direct stock market investing may be appropriate. For someone who values protection from negative index credits, life insurance, living benefits, and tax diversification, an IUL may deserve consideration. The answer does not always have to be one or the other. The strongest strategy may involve multiple financial tools. But the simple mathematics of loss can paint a different picture. Here is why avoiding a major loss can matter. If you lose 10%, you need an 11.1% gain to recover. If you lose 20%, you need a 25% gain. If you lose 30%, you need approximately a 42.9% gain. And if you lose 50%, you need a 100% gain just to return to your original value. Losses and gains are not equal. A 50% loss followed by a 50% gain does not bring you back to the beginning. If $100,000 falls by 50%, it becomes $50,000. A 50% gain on $50,000 produces only $75,000. You are still $25,000 below where you started. That is why protection from major negative index credits may become increasingly valuable as retirement approaches. You are not only protecting money, you are protecting time. Your limited time. The fifth benefit is to have liquidity of your money through policy loans. Now imagine the policy has accumulated sufficient cash value. The owner may be able to request a policy loan against the available cash surrender value. This is different from taking a participant loan from a 401k. A 401k loan may be limited by federal rules, employer plan provisions, and a repayment schedule. An IRA does not permit participant loans at all. With an IUL, the policy contract controls the loan's availability and terms. You are generally not asking your employer for permission. The money may usually be used for any purpose: retirement income, an emergency, a business, education, a home purchase, or another financial need. But a policy loan is still a loan. Interest is charged. The loan reduces available cash value and the death benefit. And excessive borrowing can cause the policy to lapse. That is why the policy must be monitored carefully. Does my money continue earning yearly dividends while I get a policy loan? You may have heard someone say, you can borrow the money and continue earning interest on the same money. Here is the accurate explanation. With a policy loan, the insurance company generally lends you money while using policy value as collateral. Depending on the policy and the loan option, some value associated with the loan may remain eligible for interest crediting. But the loan also accrues interest. The policy's performance depends on the loan rate, the interest credit, the policy charges, the loan amount, and the specific contract. There is no automatic guarantee that the interest credited will always exceed the cost of the loan. But some policies do include this feature. That is why the policy's actual loan provisions must be reviewed. Benefit 6, potential tax advantage access. Now imagine 20 or 30 years have passed. The IUL has been properly designed. It has been funded according to the plan. It has remained in force, and it has accumulated sufficient cash value. Premiums were generally paid with money that had already been taxed. Cash value may have accumulated on a tax-deferred basis, and the owner may potentially access available policy value through properly structured withdrawals and policy loans without creating current taxable income. This is one of the most compelling potential benefits of an IUL. With a traditional 401k, taxable distributions are generally included in income. With a traditional IRA, taxable distributions are generally included in income. A Roth account may provide qualified tax-free distributions, but annual contribution and income limitations may apply. An IUL may provide an additional tax-advantaged financial bucket. But the words tax-free should never be used carelessly. For the strategy to operate as intended, the policy must qualify as life insurance. It should generally avoid becoming a modified endowment contract when non-MEC treatment is intended. It must remain in force. Policy charges must continue to be supported, and outstanding loans must be carefully managed. If the policy lapses or is surrendered with gains or outstanding loans, taxes may become due. Tax laws may also change. The accurate statement is, a properly structured and managed non-MEC life insurance policy may provide potentially income tax-free access through withdrawals and policy loans under current tax law. Once again, the word that should get you excited is the word income tax-free access. Benefit 7 is what we call insurance living benefits, or benefits you can receive while you are alive. Now comes another part of the package. What happens if you do not die, but life changes completely? What happens if you are diagnosed with cancer? What happens if you experience a heart attack or stroke? What happens if a chronic illness leaves you unable to perform basic daily activities without assistance? Some IUL policies offer living benefit riders. These riders may allow the insured to accelerate part of the death benefit after a qualifying critical, chronic, or terminal illness. That money may help with medical expenses, household bills, mortgage payments, lost income, home modifications, caregiving expenses, or other financial needs. The qualifications vary by insurance company, policy, and state. They do not cover every illness, injury, or disability. An accelerating part of the death benefit reduces the amount remaining for beneficiaries. But these riders may provide something a traditional retirement account was never designed to provide: access to insurance benefits while the insured is still alive. What about disability? An IUL should not be presented as a complete replacement for disability income insurance. Traditional disability insurance is specifically designed to replace part of a person's income after a qualifying disability prevents that person from working. Some life insurance policies may offer disability-related riders, such as a waiver of premium, but those provisions vary. A complete protection strategy may include health insurance for medical expenses, disability insurance for income replacement, life insurance for family protection, retirement accounts for long-term accumulation, and an IUL for permanent life insurance, cash value potential, living benefits, and tax diversification. One product does not have to solve every problem, but every major risk should have a strategy. Now step back and look at the full picture. A properly designed IUL may combine permanent life insurance, a contractual death benefit, cash value accumulation potential, interest crediting linked to an index, protection from negative index credits through a 0% floor, potential access through policy loans and withdrawals, potential tax advantage retirement access, living benefit riders when available and when qualification requirements are satisfied, and a generally income tax-free death benefit for beneficiaries under current federal law. That is what makes the IUL different. It is not simply a retirement account. It is not simply life insurance. It is a package designed to address several possible chapters of your financial life. If you live a long life, cash value may help provide flexibility. If the market falls, the 0% floor may protect against a negative index credit. If you need access to money, policy loans may provide another option. If you experience a qualifying serious illness, living benefits may be available. If you die too soon, the death benefit may protect your family. And if the policy is properly managed, it may help create tax diversification in retirement. But every great movie has a warning. An IUL is not magic. It is not free. You need to fill out an application to get approved. It is not automatically appropriate for everyone. It includes insurance costs and policy expenses. Caps and participation rates can change. Policy loans charge interest. Withdrawals and loans reduce available cash value and death benefits. An underfunded or poorly managed policy can lapse, and non-guaranteed values may be lower than originally illustrated. That is why the policy must be done by an agent or agency who can design correctly, funded correctly, reviewed regularly, and managed responsibly. The product is only as strong as the strategy behind it. So ask yourself, do you want your entire retirement dependent on only one type of account? One tax treatment? One market strategy? One set of government rules? And one outcome? That you remain healthy and live long enough to complete the plan? Or would you rather build several financial buckets? A 401k bucket for an employer match and market accumulation, an IRA or Roth bucket for additional retirement savings, an emergency bucket for short-term needs, an investment bucket for long-term growth, and possibly an IUL bucket designed to combine protection, accumulation, access, living benefits, tax diversification, and legacy. This is not about choosing one tool and rejecting everything else. It is about building a complete financial story. At the Union Financial, we do not ask you to purchase a policy based on promises. We ask you to look at the numbers, your age, your health, your income, your retirement timeline, your existing 401k, your IRA, your Roth accounts, your protection needs, and the amount you can comfortably contribute. Then we can show you a personalized illustration, not somebody else's policy, not a social media example. Your numbers. You will see the planned premium, the cost of insurance, the policy expenses, the guaranteed values, the non-guaranteed values, the cap and participation rate, the projected cash value, the effect of policy loans, the living benefit provisions, and the death benefit available to your family. We can compare the strategy with what you already have, side by side, dollar by dollar, benefit by benefit. Then you can decide whether an IUL belongs in your financial plan. Because the best financial decisions are not made from fear. They are made from understanding. You have already protected your home. You have protected your car. You have protected your health. Now it may be time to ask, what is protecting your retirement income and the family depending on it? Schedule your complimentary retirement tax and protection analysis with Union Financial. Discover whether this special financial package could help strengthen the retirement house you are building. Because a great retirement story does not happen by accident. It is written one informed decision at a time.